What if you could quadruple your money in a single voyage? Amsterdam promised exactly that in 1602. Shares, a piece of paper that said you owned part of a company, ships sailing to Asia, cargo you'd never see, profits that might never come. This wasn't like buying a piece of property. No guarantees. Your neighbor bought shares, your friends at the tavern bought shares, but who actually profited? Hey, hoi, welcome to the Dutch door. Kom maar in. Ga je mee? For centuries, trade had worked the same way. A merchant wanted to send a ship to Asia, he'd find investors. They'd pool money for one voyage. Ship came back, they'd split the profit. A ship sank, they lost everything. Then the voyage was over, done. You started again from scratch. In 1602, Amsterdam's Dutch East India Company, the VOC, introduced something completely new. A company could now raise money from hundreds of people at once, each buying a small slice of a voyage they would never see. It sounded logical on paper. If one ship failed, it did not destroy one family. The risk was spread, shared, softened. This was revolutionary. Suddenly, a shopkeeper could own a piece of global trade. A widow could buy one share and have income for life. Anyone with a little money could get in. The idea felt modern, almost magical. A few coins could travel across oceans and come back multiplied. The promise was simple. The VOC would keep growing, and so would your wealth. Thousands of people bought in. But if everyone could buy shares, why did only a few people get rich? The beurs, the Amsterdam stock market, looked public, but information inside it never flowed evenly. A few traders arrived with letters tucked under their coats. News from Lisbon, Hamburg, Venice, or the Canary Islands. These messages carried everything that mattered. Storms on the Cape route, rumors of war in Asia, a captain who'd fallen ill, a ship spotted near Madagascar. Those who received these letters first always moved first. They bought when others hesitated, and they sold before anyone sensed danger. Meanwhile, most people stood on the trading floor with nothing more than guesses. A cooper, a baker, a dock worker, they all saw the same prices, but not the reasons behind them. A sudden drop might have meant a wrecked ship or simply a rumor whispered an hour earlier in a merchant's back room. One traded based on knowledge, the other traded based on hope. Today, we call this insider trading, trading on information that other people don't have access to. In most countries now, it's illegal. You can go to prison for it. But in 1602, it was just called business. The bourse wasn't a level playing field, it was a race, and most people didn't even know they were behind. So if you couldn't get information fast enough, how were you supposed to win? Here's what the smart merchants figured out. You didn't have to bet on ships succeeding, you could profit either way. They didn't just buy shares, they insured the ships. A single voyage carried enormous risk: storms, pirates, disease, spoiled goods. One disaster could wipe out an investor, but insurers weren't tied to one ship. They held dozens of policies at once. If one vessel disappeared, the others covered the loss. It was the safest position in a dangerous world. Maritime insurance became its own market, bigger than the stock market itself. You could insure a voyage for a premium. If the ship came back, you kept the premium. If it sank, you paid out. But you'd already priced that risk in. The merchants who understood this made fortunes. They turned risk into revenue. They didn't need the ships to succeed. They just needed to understand the odds better than anyone else. And ordinary investors, most of them, didn't even know this insurance market existed. They were still buying shares, hoping their one ship wouldn't sink. The real money wasn't in owning the company, it was in controlling the risk. But if you didn't know that game existed, what were you actually playing? And while there's been talk of tulips and spices creating fortunes, normally the story was much simpler. Most VOC shareholders made modest returns, maybe 5% in a good year. Maybe nothing. Sometimes they lost money. The extraordinary profits, those were rare, and they usually went to the same people. Here's how. In 1606, the VOC ship Banda returned to Amsterdam. The dock merchants saw it come in. Cloves, thousands of pounds. They bought shares immediately. By the time ordinary investors heard the news, the price had already jumped 20%. The dock merchants were selling. Everyone else was buying at the peak. By 1609, Isaac Lemaire figured out something darker. You could profit from bad news, too. He invented short selling. Borrow shares, sell them, spread false rumors that ships were lost, watch prices crash, buy back cheap and return the shares, keep the difference. It was devastating. Families lost their savings on lies. The authorities eventually banned him, but he kept his fortune. And it didn't stop there. By 1637, tulip mania hit. The rarest bulb sold for 10,000 guilders, 20 years of wages, enough for a canal mansion. Sailors quit their jobs to trade tulips, until one day in February, nobody bought. Prices collapsed. The sailors went back to their ships. The merchants who'd sold at the peak, they kept their mansions. Today this would be illegal. Market manipulation, prison time, massive fines. But in 1602, Lemaire just got kicked out of the exchange. Was Amsterdam running the world's first financial scam, or had they just invented something nobody yet knew how to control? Amsterdam really wasn't a scam. It was a market, and markets do what they've always done. They reward information. The problem is information costs money. Access costs money. Time costs money. A small group of people had all three. Most didn't. Today we have rules. Insider trading is illegal. Market manipulation is illegal. You can't spread lies to move stock prices. You can't trade on secrets. And people do go to jail for it. Martha Stewart, 5 months in prison for insider trading. Raj Rajaratnam, 11 years and $92 million fine. SAC Capital, $1.8 billion, the biggest insider trading case in history. But people still get rich legally. Warren Buffett built an $80 billion fortune by doing one thing: reading. Annual reports, financial statements, industry trends, information that was public, that most people didn't bother to understand. He didn't have secrets, he just did the work. The difference between Buffett and Lemaire: Buffett used public information better than everyone else. Lemaire used private information that nobody else could access. But the game stayed the same. A few people had the facts and everyone else guessed. High-frequency traders get data microseconds faster. Hedge funds pay millions for research ordinary people will never see. Company executives still know things before you do. The laws have closed the worst gaps. But that basic advantage, being closer to the information, understanding the game better than everyone else, that never disappeared. The Great Depression didn't just break the markets. It broke lives. Banks failed. Businesses collapsed. Millions lost their jobs, their homes, their savings. Factories shut down. Farms went under. Whole towns emptied out. The shock didn't stay inside the United States. It spread across Europe, feeding unemployment, anger, nationalism. Governments fell. Extremists rose. The economic collapse helped clear the path to the Second World War. Recovery took more than a decade, and for many families, it never fully came. Then, almost a century later, it happened again. The 2008 crash wiped out pensions, paychecks, and entire neighborhoods. People who'd spent years building a life lost everything in a few months. Businesses that had survived for generations shut their doors. Governments rushed in with rescue plans, but the damage stayed with ordinary people long after the headlines moved on. The pattern was familiar. A small group took the risks, and everyone else absorbed the impact. Markets recovered, stock prices rose again. Thousands of families never did. And when it all collapses, the insiders are already gone. In 1602, the market worked best for the people closest to the information. 400 years later, with all our rules and protections, does it really work that differently?